On the podcast with us today is Andy Vaughan. Andy, welcome to the podcast.
Thanks, Dan. Appreciate it.
Well, Andy, I want you to get us started. We're going to be diving in today on this 36-unit property called the Cambridge Apartments, located in Greensboro, North Carolina. It's a 1970 vintage. You guys closed on in June of 2018. And before we get started and diving into that particular deal, give us a little bit of background about yourself, of what you did prior to multifamily, and then where your current focus is right now in the multifamily space.
Okay. Yeah. Married for 26 years, 3 kids, had our first grandchild this past year. So
Congratulations.
Thank you. Thank you. I'm in West Monroe, Louisiana, up in the northeast part of the state. And background is in insurance. Started the insurance career in 93 and have owned multiple insurance agencies and just sold one last year, which freed up some time to be able to work on these type projects.
Well, that's cool. That's cool. So what kind of insurance were you in?
All types. I had a property and casualty agency, which is the one that I sold. And then I still have an agency where we do employee benefits, group health stuff.
Did you ever get into like the larger commercial apartment, type insurance or anything like that?
Larger commercial insurance, not apartments.
Okay. Like retail and strip malls, stuff like that.
Well, more like oil and gas companies and things of that nature. Yep.
Okay. All right. Well, that's pretty neat. Well, dive into this deal real quick with us and kind of tell us, how first get started, and tell us how you actually found this deal and sourced it.
Well, I'm involved in a coaching program that I started February of last year, right around the time I was getting ready to sell the agency. And that consisted of the coach, the mentor, and then myself and 2 others, where we would have calls every other week like this, a Zoom call. And when I got involved in that at the end of February, the guy that ended up being my partner on this deal already had this deal under contract. So we got to see firsthand as he's walking through the steps and dealing with the lenders and doing all the due diligence and insurance agents and all these type issues or whatever, and hurdles he had to jump over. So seeing all this play out and, obviously getting to learn firsthand, learn a lot from that. But he got up to, I guess it was probably the first part of April, and said that he was going to be a couple of $100,000 short on capital. Of course, looking for the first deal, my ears kind of perked up or whatever. And so I reached out to him and asked him if he'd be willing to partner on it, if I could bring capital to it and help him close the deal. And so he sent all the information over to me, and we spent the next probably week and a half going through it, made sure I had a good understanding of it and liked the deal, and then jumped on board.
So he was the partner in this deal that was too shy to get on the camera with me today, right?
I'm sure he'll get on.
I'm just messing with you.
I'm sure he wouldn't mind that at all.
Yeah. So you didn't get thrown. You didn't get thrown to the Dan Handford Wolves or anything like that. You gotten scared or anything.
That's right.
Well, so talk to me a little bit. So when you got involved with this deal, did you get involved? So you obviously got involved after he found the deal. Were you involved with part of the process of like the due diligence and the financing and stuff like that?
No, I mean, actually on this deal, ironically, he already had all that heavy lifting done. Kind of the backstory is there was an owner there that owned a property in Virginia that he had under contract. My partner had under contract previously. In the due diligence process, that deal fell through. So the owner felt kind of bad about it. It was a lot of deferred maintenance and issues with the plumbing and roofs and ACs and that sort of thing. So he said, well, I've got this other deal, this 36 unit. He was trying to find something in a certain price point that he knew what amount of capital he already had with himself and other investors. And long story short, he said, I got this other deal in Greensboro. Would you be interested in that? So that probably started around end of January of last year. So it was an off-market deal. brought to him. And, so yeah, by the time I got involved, I mean, he had all the due diligence had already been done. Already had the lender on board. We were going through that process. And so, yeah, I mean, a lot of that heavy lifting had already been done by him.
Sure. Well, let's talk a little bit about some of that stuff. I'm going to kind of go into it a little bit deep, just so we can kind of see how you guys structured it and how you guys put it together. Because it sounds to me like you kind of came in and kind of, almost saved the deal, if you will, by being able to come in from the equity side of things. Is that correct?
Well, I mean, that was the intention. It evolved over the course of some time. Initially when I got involved, when he sent the information over, the deal was set up to be an 80-20 split. With 20% going to the general partnership. He and I worked out a deal on what our arrangement and split would be on the GP side. And then as the deal proceeded, he told me initially we was going to be a couple $100,000 short. I felt pretty confident that I could raise a couple $100,000 to get the deal closed. Like I said, that was early March of last year. And then as we went through the process, I don't know if you remember this or worked on any deals about that time. I mean, interest rates started creeping up. Different things happened along the way. As interest rates creep up, obviously your payments more, obviously loan proceeds get cut. All those sorts of things started happening. And what initially was he thought he was going to be a couple $100,000 short, ended up being about $460,000 short. So it was all hands on deck for a couple of months trying to get it over the line. But we got it there. We thought we were going to close in May, and it got pushed to June. Took us another month. But like I said, we're working with the previous owner and him feeling bad about the deal. I mean, obviously we've learned a lot since then, wanting to put extensions in the contracts and all that. We really fortunately didn't have to worry about this time. The owner was just willing to work with us and along the way. So,
because it seems like if he was starting to work on it and talking to you about it in January, and it took until June to close, there's definitely multiple rounds of extensions that the seller was able to concede on.
Yeah, and some of that was lender issues, going through the broker and that sort of thing. So a lot of the delays was on their end. But then when it really got up time to it, you know how they do these things. You don't actually get your closing documents till about 3 days before closing to see what you actually have to come up with. And then the other thing that came into play was we had three investors investing through their IRA. So a lot of those, that takes a while. That's just not them like wiring money. So a lot of that was delayed. So we had money that we were counting on to close that wasn't actually in our account yet. So then we had to go out and find other money to be able to close. So yeah, it was fun. It was interesting.
So I like how you say it was fun, because it definitely gets you into that mode of having to start to go out there and talk to people about what you're doing and raising that money. And you don't really know how hard and challenging that piece of it is until you actually have something that you're raising money for.
Right. Yeah. And in that coaching program, I mean, that's kind of one of the first steps, is to kind of come up with a sample deal and start having those conversations with potential investors. And I was at that point where I had just, came up with my sample deal, put all that together, and then it quickly turned into a live deal. And, you feel a lot more pressure when there's a live deal versus just talking in theory.
Got to step out of that comfort zone sometimes.
Outside the comfort zone. That's right.
So what was the actual purchase price on this one?
1.875.
1.875. And were there any acquisition fees in this one? Asset management, disposition?
Well, that's another thing. I mean, it's as things progressed, interest rates, loan proceeds, all those issues, we ended up having to restructure the deal. And instead of 80-20, we moved it to 75-25 with a preferred return. And ultimately, once we really got down to the wire to make the numbers work and everything, we had to forego acquisition fees and asset management fee on this one just to get the deal done.
So you went from an 80-20 split to a 75-25?
Correct. With a 8% preferred return.
So how did that make it better? Did that make it better for the investors?
Yeah. I mean, it made the numbers look better on the investor side because of the preferred return.
Okay.
Once we threw that in there, then if you're going to give them a preferred return, generally the GP ends up getting more equity, a bigger piece of the deal. If you're guaranteeing them that preferred return, not guaranteeing them, but giving them the preferred return.
So what's the plan on this particular asset as far as like the hold period and return projections and stuff like that?
It's a 5-year plan. Really, way things are progressing, I don't really see us holding it 5 years. Greensboro is a pretty hot market. And, this is a really interesting type deal that they always say, the best house or the worst house in the best neighborhoods. And this is this type deal with this apartment complex. I mean, it's definitely a C tenant mix that was in there, C building with it being 70 construction, but it's really right on the line of the C area and the A area, because right next door to it is like a senior assisted living facility. Right on the side of that's a large bank. Right across the street is like the national headquarters for the VF, the corporation that owns all, Wrangler, North Face, all that kind of stuff. They got a Harris Teeter and Starbucks and Chick-fil-A and all that stuff right down the road too. So it's really right on the edge. So we felt confident looking at rent comps in the area and vacancy comps, all that sort of stuff, that we could go in and put some money into them and raise rents pretty handily and get the NOI up to be able to sell it.
So on the 5-year projection, what were the IRR projections on it?
Let's see. Let me find that here.
And as you're looking that up, my next question will probably be around the cash on cash as well.
Yeah, projected out cash on cash was a little over 8. IRR at 14.6. So average annual return we have projected out, it's a little over 16.5.
So when you might not recall this, but when you had it set up the other way around where it was an 80-20 split, how did that affect your IRR? I would think that it actually dropped the IRR down because you're making it, I guess, a less riskier deal for your investors by giving them that 8 pref, but you're also reducing their equity position as well.
Let's see.
Actually, no.
That's 75-25.
Yeah.
I think, like I said, what we ended up having to do is, in order to keep those returns the same, is why we ended up having to do the preferred return. But
I see what you're saying. So on this one with the 8% preferred return, in order to get the same IRR or similar IRR to give yourself more proceeds on the back end, is there actually a catch up on the 8% preferred return?
You talking about in the operating agreement?
Well, like whenever you obviously with the preferred return and you're holding that particular project on the preferred return, the first 8% goes to investors and then you have that split of 75-25. But on a catch-up provision whenever the property is sold, or sometimes people catch up every year, they'll catch up the actual GP to that 8% before it's split 75-25.
No, this one, in other words, let's say, for example, if year one, let's say returns were only 5% year one, then we got to catch up that other 3%. Obviously, either through operations or at sale, one of the two.
And that would be what's called a cumulative preferred return, where if you don't hit it one year, you get the next year. It would just tack on. But if you hit 9% one year, you don't get 7 the next year. It's still 8% the next year as well. But on a catch-up provision, maybe I'm not asking you the right way. I'm not referring to accumulation of a non-performing preferred return, but whenever are you guys doing just a straight preferred return where all the proceeds go to the investors up to 8% and then you have that split? Or are you doing the 8% preferred return to investors and then the GP gets their 8% and then you do the split?
No. It's 8% preferred to the investor and then split 75-25 after that.
With nothing at the end being caught up or anything like that.
Correct.
Did you have any like secondary hurdle once you hit like certain IRR targets or anything like that?
No, we don't want to complicate it that much. I mean, I've got a good friend of mine in Atlanta that actually introduced me to all this, and I mean, he has so many hurdles in it and changes and all that. You can complicate it too much to where your potential investors don't understand the deal, and obviously they're not going to invest. So, yeah, we just try to keep it as simple as possible.
Sure. No, that definitely makes sense. And that's the biggest thing about understanding, where your investors are and what you think that they can understand and stuff like that too. So that's always something you have to know whenever you're talking to your investors as to, whether or not they're going to be able to understand the whole structure and, feel uncomfortable, because the moment somebody feels uncomfortable, that's usually when they say no. So a confused mind always says no.
That's right. And most honestly, I mean, most of the investors, until you get to dealing with people that have done this and invested in syndications and things of that nature before, I mean, most of your investors, or most of my investors anyway, didn't know what a preferred return was to begin with. So I had to educate them on that to begin with. Mm-hmm. And let them know that was to protect them and to help them be sure that they get their returns. So
yeah. Now, on this particular property, did your partner put up any, or did you help put up any of the earnest money? I know by the time you got in, you already had the deal under contract and stuff, but was there any of that involved?
Yeah, I mean, he had already, like I said, by the time I got involved, I mean, he already had all the earnest money put up, and I mean, all that. I think it was 1% earnest money. So yeah, he had all that done, already paid for all the, phase one, and all of that stuff had already been done.
So what are some of the potential issues, or not potential, what were some of the issues that you were told about that came up during the due diligence process?
I mean, nothing really. I mean, it was more, water conservation type stuff, lighting. I mean, the previous owner had put about $250,000 already in it. It's got a brand new parking lot, all new roofs. Not all of the AC units had been changed out, but a good number had been. Laundry facility had already been, redone, revamped. So a lot of that stuff had already been done. It's just basically getting in the interiors mm-hmm. and renovating those to get those up to where they needed to be able to get the rent bump we wanted.
So how much did you guys project as far as the CapEx?
Let's see. On this one, CapEx, I think was about 110, just shy of 110.
And for that 110, what was the projection for the rent bumps?
As far as the renovations you're talking about?
Yeah, so you're putting 110,000 into the renovations, correct?
Well, I mean, some of that's reserves.
Oh no, I'm not talking about the CapEx reserves. I'm talking about the actual
we had about
budget.
Yeah, we had about 64,000 as far as CapEx, true CapEx, no reserves, but yeah, CapEx budgeted.
So
you were banking about 4,500 a unit.
Maybe my math isn't coming out correctly. So that 4,500 a unit, that would be 162,000. So you said 162,000.
Yeah, but I forget the exact number. Some of those had already been renovated.
Okay.
Yeah, we were just focusing on the ones that had not.
So let's just call it maybe say $5,000 to $6,000 a door for the ones that were non-renovated or whatever.
I think we had $4,500 a door is what we budgeted for those that had not been renovated.
Oh, on the non-renovated ones?
Correct.
Okay. All right. So on those units that you were renovating, what were you projecting the rent bumps to be?
Well, it's got 24 2-bedroom, 1 baths, and then 12 1-1s. So when we looked at the T12, The average rent was like in the 400 range, just under $500. So we had projected out on the ones getting those up to 525, and on the two ones getting to 625. What we're actually seeing and accomplishing, though, is on the ones that we're going through the full-blown renovation. The renovations are costing us a little bit more than what we anticipated. However, we're getting 725 instead of the 625.
Wow, that's nice. So for the 4,500 a door, what was that? What's that renovation look like? What are you doing in that renovation?
Well, I mean, each one's different depending on, like, if you go into one that's, pretty much original, nothing been done. I mean, we're doing, new cabinets, new appliances, new lighting, new flooring, new plumbing fixtures. I mean, it's pretty much.
I can see that blowing $4,500 out the door.
Yeah. Yeah. And then what we've actually done is on some of those, 70s, a lot of this construction was closed off where they had a wall separating the living area and the little small galley style kitchen. And so what we've done on 3 of those is actually knock down that wall and just open it up. And we're actually getting a little extra rent bump on that. We just leased one up at $750 that we did on that. So
yeah. That's great. So it sounds to me like it's doing great, and it's going to be probably a nice little exit here, maybe even earlier than that 5-year mark, that maybe like the 2 or 3 year mark, maybe be able to do that, or maybe do a refi or something.
Yeah, hoping, maybe around year 3, being able to do something like that.
So what kind of debt did you put on it?
Fannie.
Small balance? Fannie.
Right. Yep.
And how was that process like?
Like pulling teeth. Yeah, it was very arduous. I mean, it's CMBS deals, so I mean, it's just a tough process. A lot of hoops to jump through, and like I said, I mean, a lot of things dealing with water conservation. Got to put in low flow type deals on all the fixtures by the end of year 1, things of that nature. So, there again, with this being our first deal, that was one of the kickers. We didn't really, when you're looking at a deal, putting your team together or whatever, one of the things obviously you want to do is find a good property manager. But, you need to kind of have the same game plan for the property as the property manager. So we knew before we bought it that we probably were not going to stay with this property management firm. However, they did not allow us to change, since we didn't already have an existing relationship with a property management firm. They pretty much, held our hands and made us go with the existing property manager. Then we got, like I said, we closed at the end of June. We got into November, and we actually changed November 1 to a new property management firm, but we had to go get, permission from them basically to do that. So yeah, it's not a fun process on that side.
So, this was obviously back in June of last year, June 2018. What was the interest rate that you guys locked in?
I think it was about 5.2. We had projected out, ran our numbers, I think, on like 4.8, ended up jumping to about 5.2.
You know what they are now, right?
They're back down below 5, right?
Yeah, it's about 4.1, 4.2 right now.
Yeah.
We kind of had a similar situation. We had a couple of deals closed last year, and it was like that, 4.9, 5, 5.1, 5.2, and and all of a sudden, right now, it's down to, there's some deals 3.8, 3.9. I mean, like, wow. Just crazy low rates.
Yeah, I mean, when I jumped in on it, the numbers we were looking at were, and what we were told initially going in from the loan broker, 80% proceeds, 4.8, 20 to 25 year AM, and somewhere in the 10 to 12 rate lock. And all that ended up going to, 5.2, and ultimately at 67% loan proceeds.
Man.
Yeah. Now we've still got the 25-year AM and still got the 10-year rate lock with 2-year IO. But yeah, I mean, all that makes a big difference right there at closing time when you're told that. It puts a lot of pressure to come up with that additional fund, especially when some of the money, like I said, you were counting on is coming from IRAs, and you're pushing those companies to disperse funds, and that's just a long, cumbersome process.
So let's shift here a little bit and talk about the property management company. So you had obviously third-party property management company handling this. Was there anybody on site, or was it all off-site?
Yeah, it's all off-site.
Okay, that's good. I figure with a 36 unit, you probably wouldn't have anybody like that, but I know sometimes they'll have somebody like living in one of the units that's kind of like the on-site person. But so they had a completely off-site third-party management company. Was that management company performing well, or were they not? And that's why you kind of got them off, or
No,
was
I
it
mean,
more like a personality conflict?
the story on this really and truly was probably whenever the previous owner bought it, it was more like a C minus or D type property. And I think that property manager and property management company was, really, I think they did a great job getting it from that C minus and D. A lot of walking traffic through the property. So they put up a lot of fencing, a lot of, security lighting and cameras and different things of that nature, and cut down a lot of that type activity and brought it to, a good solid C or C plus property.
Mm-hmm.
But they weren't, they just weren't set up. I mean, it was a husband and wife deal, a broker there in, real estate broker there in Greensboro type thing. And they just really weren't set up. I mean, they were running Appfolio, ironically, but they didn't even realize that they could give us access to be able to view everything. So we were the first ones that they, went through that process with. And that was probably, at least 2 or 3 months in before they got all that set up. So they just, had in that market, and you're dealing with a 36 unit, most of the property managers are just, used to dealing with single family or duplexes or something of that nature. And it's just, so when you're wanting to get visibility of everything and, daily login or whatever, see who's paid, who hadn't paid, that, they just weren't set up that way. Mm-hmm. So we had to, not that we had to walk them through it, but we pretty much had to argue with them for a while to let them know, yeah, you can set it up to give us visibility. And they're like, oh, we're not familiar with that. We got to call Appfolio, make sure that, compliant, all that sort of thing. So, yeah, I mean, he did a good job getting it from a severely, just a property with lots of tenant issues and that nature, and getting it up to that solid C. But he just, they didn't agree with our business plan. Number one, that's what I'm talking about as far as putting money in on the renovations on the exteriors. They just didn't believe that we could get those. He didn't believe we could get the rates bumped up to $625 on the 2 bedrooms, So, and then now we're getting, like I say, on the fully renovated ones, we're getting $725 on those. So, so the stuff even that he had already, previous owner had renovated, which is not, I mean, we're doing a lot better renovation, a lot higher quality. We're ripping all the carpet out and going in with the, vinyl plank. So we don't have to deal with the carpet at turns and things of that nature. So put a little bit more money into it on the renovations, but like I say, getting the extra $100 bump on the ones that they had previously renovated. When those come vacant, we turn those and, touch up paint or whatever, then we're getting $625 on those. And he didn't think we could get that.
So let's talk about the occupancy of this one before you guys closed on it. What was the occupancy, prior to closing?
I think we were probably at 94%. I think we had 2 vacancies.
Okay. And what was the economic occupancy?
It was close. I mean, there may have been a handful, maybe 3 or 4 tenants that were behind, or that sort of thing. But ironically, it's set up where it's sort of a horseshoe consisting of 3 buildings. So the 2 bedrooms are, if you will, on the sides, and then the 1 bedroom building is on the end. We had one, if you want to call it the problem child, or the building with all the main issues when we took it over. So we knew we were going to have some issues there and do some evictions, and but that would give us the opportunity to go in and do the renovations as well. So we knew occupancy would drop, but that's part of the first year and a half plan to get in there and renovate to increase the rents.
Where is the occupancy today?
Today, I think we had a call with the property manager this morning, and we're at 88%.
Okay.
We've got 4 units that are currently in different various stages of renovation. So they should be ready to go online by the end of the month.
What was the projection on how long it was going to take you to renovate all 36, or the remaining 24, or however many it was that was remaining that need to be renovated?
Yeah, we thought we could do it in the first year. Now, that's proving a little there again. I mean, even this property management company that we moved to, there again, they use Rent Manager instead of Appfolio, but same type deal. They'd never set it up to where, give people visibility, and that's just, that's probably the hardest thing in dealing with this is not only property management, but project management, and overseeing the renovations in a timely fashion. So when we changed to this other property manager in November, then, we were probably really first part of December before we actually decided what we wanted to do and which units and all that sort of stuff. And then, then we get hit. Greensboro got hit with a big snowstorm, like apocalyptic snowstorm for them. I think probably that first week of December, somewhere in there. So that delayed it. And then, of course, with Christmas and all those sorts of things with the holidays and stuff. So, that's probably the biggest source of frustration is getting each project, across the finish line when it should, and dealing with that. So, yeah.
So let's go back to the amount of capital that you guys needed to raise in order to get this property. How much capital did you actually have to bring to the table in order to close this deal? Like all in
order to close.
Or how much was the total equity raise?
Yeah, the total equity raise with everything. I mean, we ended up having to raise $790.
Okay, that sounds about right with the 60.
Just shy of 800,000. Yeah. So like I said, when the proceeds got cut, you had to raise more. But then we ended up having, obviously, as soon as we did, like the day that we closed, we ended up having, by the time I wired everything out, I think I had $1,700 left in the account. It was one of those type deals. And then it's like the following, week or weeks coming, then all the IRA money starts hitting and that kind of stuff. So yeah, it was a nail biter.
Well, sometimes that's the way it happens, but as long as you get it through that finish line and everything else comes out, even if it's post-closing, then you're usually pretty good. So you actually, it sounds to me like that's kind of how you guys ended up. So that's really good.
Yeah. It was something.
So how many investors do you have in this project?
I think we got about 8. I think 8, including myself and my partner.
Okay, that's good. And so you guys are obviously investing alongside your investors on the LP side as well, or are you just primarily on the GP side?
No, both. On both.
That's good. I like to see that alignment of interest. We do that on all of our projects that we put together as well. Because I feel like I want to have my own money in that on the LP side, so that I'm always aligned with my investors. And the main reason why I'm getting into this space is for the tax advantages of it. And you can't take as much tax advantages unless you have that those investments out there. So
yeah, and your investors want to. I like knowing obviously that you're investing in the deal as well.
Yeah. So were you the one that primarily brought all those investors, or was it kind of a mix between you and your partner?
It was a mix. Yeah, it was a mix. I mean, originally, like I said, he was trying to find a deal. My partner was trying to find a deal that was, small enough that he thought he could buy it off and handle, not only with all the capital that he brought, but then maybe just a hand, 2 or 3 other investors. He thought he could, get it across the finish line. And when everything kind of started going sideways and, that sort of thing, then, he thought he would be a couple $100,000 short. And then, like I said, the couple of 100,000 ended up adding another couple of 100,000, some change to it. So, but yeah, I mean, it was all hands on deck. I mean, it was both of our first deals. So, obviously, I guess everybody's different, but we both thought it would be easier to raise, than what ended up happening. Yeah, I guess that's the way I'm wired anyway. I always thought it'd be, it's nothing. I mean, I've already talked to enough people that I know that are interested in doing something like this. So, but when it gets down time to it, to actually wire funds, it's a different story. You hear all sorts of, it's not a bad time. I mean, it's a bad time, or this, that, and the other. So, yeah, we thought it would be easier, but it was all hands on deck. Actually, he ended up that last week, and honestly, he ended up bringing a rather large investor in, who invested in. This guy has a lot of background in commercial real estate investments, but he'd never done multifamily, all warehouse and office retail, things of that nature. So somehow or another, I can't even remember, friend of a friend, type deal or whatever, my partner ended up having a conversation with him, and he's like, yeah, I've been wanting to, check out this multifamily deal. And so, my partner lives in Boston, right outside of Boston. And this particular guy, I think, is like from New Hampshire, Vermont, Rhode Island, somewhere in there. And so my partner, Seth, I mean, he actually got in the vehicle and drove down, because the guy was like, I've never met you before or whatever. So it was that type of deal. And that guy ended up wiring his funds in literally. I mean, his funds came across the morning that I had to wire funds out. I mean, it was that type. It made a giant swishing noise as it passed through the account.
That's funny. That's funny. Well, let me ask you this. So I think this is probably an area where, a lot of newer investors like yourself and your partner in the beginning there kind of thought, hey, I think this is going to be an easy process. And, and I will say, I thought the same thing. I think a lot of new investors think that way. And you start to, like you said, start to talk to people and they're interested. And then when it comes to actually, wiring those funds, that's when the truth comes out, if you will. And, you really know who can actually perform. And so how many people did you end up actually talking to get those 6 investors? Because you really had 8, including you and your partner. So you really had 6 investors that came in with you on this project. So how many people did you end up talking with between possibly you and your partner that ended up, investing?
Well, I had 4 that invested, and he probably had another 4, so maybe there's 10 of us all together somewhere. Okay. But out of the, I don't know. I mean, I probably talked to 30, 40 different people, different conversations. There's all kinds of funny stories, but with it being the first deal, I didn't do a good job really on educating the potential investor on the process. So like one guy in particular, oh yeah. And then when it gets down to it, okay, you gotta sign the subscription agreement, and here's the PPM. Let's go through that. And he's like, whoa, wait, what? I mean, you're talking about a 100-page document. He's like, I thought this was sort of a handshake type deal. I'm like, no. So he didn't do it because of that. I mean, it's just, see all kinds of different things that you run into, but yeah, so I got 4, and I think he probably got 4 or 5, somewhere in that range. But yeah, we each talked. I mean, it got to the point where if we could think of someone that we thought might be interested, or, I mean, it got to the point, well, who do you know that you think might be interested, and all those sorts of things,
Yeah.
But
so I have 2 last questions for you along this particular project and deal. And it's the 2 questions that I think I already know how you're going to answer them because of some of the things that have gone on during this episode. But The first of the last two questions is, what did you find that was easy during this entire process that you might have thought was harder before you got into it?
Well, I mean, the answer to that obviously is to find the first deal.
Especially for you.
Yeah, because I started that mentoring, that coaching program thinking, I mean, I'm going to build relationships with brokers, and it's just going to take some time to, you hear all these different people in podcasts talk about, I got to analyze 100 deals to find one. And, and I'm just now starting out reaching out to brokers. It's just going to take a while, So yeah, that's what I guess, I don't know if easy is the right word, but happened a lot faster than what I thought.
Mm-hmm.
So that would be how I would answer that. Is just the first deal came much quicker than what I was expecting.
And then the last question is kind of the opposite of that, is what did you find that was harder than expected during this entire process?
I mean, that's obviously property management on a 36 unit. Finding competent property management that can actually execute your business plan on a 36 unit. That's the hardest thing. Yep. Mm. And we still don't have that all ironed out yet, So yeah, it's just that, and that's one of the things that we've now learned on this deal is that, you're kind of in that no man's land. Like I said, he lives in Boston area. I'm in Louisiana, and the property's in Greensboro. Well, obviously we can't manage it or check on things and that sort of thing. So you're relying on third party management, and they've got other people they're managing for and all those sorts of things. So, if it was property was local to us, or if the property was much larger where we could deal with a more regional or national property manager, that could deal with the projects and the renovations and things of that nature, it would be a lot better and easier for us. Yeah.
Well, Andy, I want to thank you so much for taking some time to be with us here today and kind of sharing some of your insights and the golden nuggets on this particular asset. Looking forward to continuing to follow you. And then as you continue to close more deals, would love to have you back as you close more deals. So keeping in mind as you close more deals, but how can investors and people listening, how can they reach out to you if they have further questions for you, want to pick your brain, or, maybe even join you on the next project?
Yeah, I mean, email is andy@back9investors.com. So email me or whatever. Phone, I'll give out my phone number. I'm not afraid to do that. It's 318-614-0681. So if they want to call or text or email, whatever, I'm on, on LinkedIn, pretty regular. Not on Facebook that much, but I like LinkedIn. So what? Yeah.
Well, and I'll make sure that in the show notes that we put that information as well, so people can have the access to that information into the future as well. And thanks again, Andy, for coming on, and looking forward to continuing to see you grow as well.
Thanks a lot, Dan. I appreciate the opportunity.
Right. Thanks, Andy.